Coming up today, stocks close higher. Trump says the US is in a trade war with China. Will they try and cause a market sell-off? Besant dials up the rhetoric. Another way to play the AI boom. Retail traders buy the dip. Will it turn out to be right? And the alarming signal we just got that could be a sign of the times. You don't want to miss this one, guys. Let's go. Well, it was a pretty bullish day across the board. All the indices finishing higher, even though we did see a bit of weakness in crypto and some meme stocks, as we are getting some signs of exhaustion and potential short-term technical tops. And September CPI inflation was supposed to be released today, but with the US government still shut down, no signs of reopening anytime soon. Instead, it's going to be released next week on the 24th, even if the shutdown's not over. And stick with me today, because later on in this video, I'm going to show you the new alarming signal we just got today, which really isn't a good sign, in my opinion. I'll explain that to you later and show you what I mean. But first off, I was a bit surprised to see the market hold up and rally today, as we're getting increased tension between the US and China, with President Trump officially declaring the US is in a trade war with China. Potential moves from China showing they may be trying to tip the US market over in order to gain leverage going into final negotiations of the all-important US-China trade deal. President Xi knows Trump doesn't want to see the market crater. That weakens his position, and so we could see increased moves from the Chinese, trying to force his hand. But Treasury Secretary Scott Bessent won't have a bar of it, blasting China as unreliable, saying they can't be trusted, and that a decline in the US stock market won't deter the US from taking strong action against China. Like we heard in April, a similar narrative as well, that they weren't too concerned with the US stock market. What was more important was resolving the huge trade imbalance and trying to bring China in line with global standards, not just on tariffs, but against the long list of Chinese unfair advantages like fixing their currency, something no other developed country does, stealing Western technology, the forced transfer of intellectual property of Western companies operating in China, hidden industrial subsidies, flooding markets, etc. The list goes on. There's a lot there to work with. But China has vowed to fight to the end in the escalating trade war, swapping barbs with the US. As we quickly approach crunch time on a possible final agreement, it could definitely heat up further before the November 10th deadline. And hopefully we don't see a flash crash, like for some reason can happen in October's. But not to worry, because Scott Bessent says we're only in the third inning of a new economic boom, driven by Trump's pro-growth policies and innovation in technology and AI. He thinks we're about to see major gains in investment, productivity, and job growth across America. And I think what's really supporting the market here is Jay Powell and his team are likely to cut rates later this month and probably again in December, along with dialing down their quantitative tightening, that is allowing bonds on their balance sheet to run off, which is effectively a form of draining liquidity. So no doubt the market likes any signs of looser monetary conditions and increased liquidity. But Jay Powell is getting his hand forced because of a weakening jobs market. And we can see that in payroll growth this year, really dropping off. And actually just looking at federal government payroll growth here in the grey, now in the second consecutive negative quarter, something we really haven't seen before, as this new government is determined to shrink the size of the government, which is actually needed in order for America to get on top of its debt. But also in the private sector, along with big policy changes in immigration, that's also causing a downsizing of the US labor market. But AI headlines continue to dominate. OpenAI is now everywhere, recently overtaking SpaceX as the largest private company in the world. As we just heard yesterday with Walmart integrating ChatGPT's instant shopping checkout tool into their website, helping to give a big rally to Walmart stock that is actually continuing today, currently trading at all-time highs. And that's kind of another way to play the AI boom. Instead of the tech companies, those making the chips, AI infrastructure stocks, some of these traditional blue chips like Walmart are transforming themselves into AI companies. They've got huge revenue bases to work with. If they can just significantly cut their costs, they're going to unlock a huge amount of new profit. Like Tom Lee has correctly pointed out, JP Morgan doing the same thing, who currently operate with 313,000 employees. Tom Lee thinks if JP Morgan switched over entirely to the blockchain, they might only need 20,000 employees and operate with far greater clarity, vision, and efficiency. Using AI, JP Morgan may end up being more of a tech company. Banks could go from trading at price to tangible book to actually having a PE multiple, similar to how Walmart is already trading around 40 times earnings, just like a tech stock. As we once again see the industry join hands, backed by the government, announcing one blockbuster deal after the other. BlackRock, GIP and MGX just announced a $40 billion data center takeover to power AI growth. The buyer consortium also includes Nvidia and Microsoft, overtaking aligned data centers to meet computing demand. They're not trying to build all their own individual AI infrastructure. They're doing it together for the benefit of the entire industry and country. The investment group will utilize a $100 billion data center capital pool they created called the AI Infrastructure Partnership to combine the capabilities of large tech players and specialized investment group. As Morgan Stanley says, the colossal AI spending spree could actually pay for itself by 2028. A big critic from AI bears is they don't think all this investment is going to actually generate a return or that it will take too long. And this comes on the back of Morgan Stanley recently creating a national security index. No doubt we'll probably see an ETF for this soon. 39 companies across 4 major industries: nuclear energy and uranium, batteries, and energy storage, which have really lit up today and this past week. We've actually got 2 of these here in our picks portfolio. Lithium stocks are important as well. We can't have a clean energy revolution without lithium, and of course rare earths. The US has to set up a big new supply chain practically overnight, deleverage from China, as these are all needed for new technologies and defense military assets as well. We also just recently heard JP Morgan on Monday announce that they're going to try and put together over $1 trillion in finance to help back these critical industries. With them too identifying 27 industries they want to focus on and help accelerate the growth across 4 themes: supply chain and advanced manufacturing, the reindustrialization of America, defense and aerospace, energy independence and resilience, and frontier and strategic technologies. As the government increasingly joins hands with the private sector looking to accelerate these key areas of importance, we just heard the US Army planning to power bases with tiny nuclear reactors, launching the Janus program to install microreactors on domestic bases by 2028, addressing strained power grids. And that's what really needs to be unlocked for AI to grow: the capacity and quality of the US grid and good reliable sources of energy, nuclear being the best. No surprise to see some big rallies and related stocks today. NuScale Power actually breaking out to all-time highs. But don't forget about wind power as well. Little known ETF, Global Wind Energy, FAN, rocketing up this last month. And of course solar will play a very important role as well. The Invesco Solar ETF having another good day. And so like I noted on Friday, there was a huge consensus that big sharp sell-off was a buy the dip opportunity. And now the numbers are showing it. Retail traders bought far more bullish call options than professional money managers. And again, we're starting to push on some records. The amount of option volume and call options. So far, retail traders appear to be correct. We have had a little bit of a bounce in the past 3 sessions. However, to my eye, we're not out of the woods just yet. I think that big, heavy red candle we got on Friday is still in play. In my opinion, we'd have to take out the highs to negate that signal, because as of right now, we're still consolidating. You could still technically call this a bear flag that's just pulling back, and we very well could retest these lows or even take them out. I do think the market is a little on edge. Just looking at volatility markets, we have seen quite a bit of flattening in the VIX term structure. Up the front jumping, closer to out the back pricing, and we can see that in the spread of the front month VIX futures contract versus the second month. Remember, all bad things happen when that goes into backwardation above 1, just like it did back in late March, going into the tariff tantrum in early April. We're sitting right on the verge of that now. So for sure, the market is on edge. Don't be surprised if we do see a bit of a rug pull and sharp sell-off. The ingredients are there for it. Same with crypto as well. Still looking a bit heavy, trading underneath short-term moving averages here. They are looking a little vulnerable. And we have seen a monster run-up in heavily shorted stocks. Again, be careful not to get your portfolio too exposed to those types of stocks, because we will inevitably have a sharp pullback in them. And especially those that have zero revenue, which often coincide with being heavily shorted. Here's a look at the $0 Club. List of stocks with a market cap greater than $1 billion that have 0 or close to 0 in revenue. Some of the most richly valued, like AST Space Mobile, $34 billion, Oklo, $25 billion. And that's the thing, no doubt these companies are likely to be around in the future. The market probably is right that they will have huge growth. They will eventually get revenue, but that doesn't mean they can't pull back 50%, 70%, 80% before that happens. Because if they can experience huge up volatility, you can bet your bottom dollar they can also experience huge down volatility. But no doubt many retail traders are having a good time out there, and we're getting plenty of posts like this. Me outperforming every single hedge fund on planet Earth without having done a single discounted cash flow analysis in my life. With this guy depicting himself as Big Bird sitting in a board meeting. And no doubt that kind of behavior is causing pain for the traditional hedge fund managers, who are the short sellers, now on track for their worst year since 2020, and they are blaming retail investors for acting irrationally, which doesn't make sense at all because the market is made up of irrational crowds. Nobody's forced, nor are stock prices, supposed to act rationally all the time. That's called the stock market. But no doubt they have to justify their negative returns to their investors somehow. So looking at the rally in non-profitable stocks, heavily shorted stocks, call option volume definitely at frothy levels, but other traditional measures of market extremes like equity flows, we're still well off those peaks from 2021. And looking at margin debt as well, relative to the market cap, is actually quite low. The market isn't levered up to the gills just yet. But back to my point earlier at the start of this video, and what I really don't think is a good sign is fund manager volatility shares filing for 5x leveraged ETFs. I thought this was actually fake news or a joke when I first saw it on my timeline, but I dug into it and realized it's not a joke. They're actually trying to do this, which I do think could be a sign of peak stupidity, because they're not just trying to lever up cryptos by 5x, they're also trying to do it for a bunch of stocks as well, like Coinbase, MicroStrategy, Tesla, and Google. So hopefully the SEC doesn't approve these, because if they do, they're going to cause a lot of innocent small investors to lose their shirt. Because in theory, being levered 5x just needs a 20% pullback to wipe out. But even if they recalibrate them daily, weekly, or whatever, just a 30% drawdown could wipe out the fund or cause a 90% or more drawdown that can't be recovered from. And so if they do go through, I would love to bet against them, but it's near impossible using public markets. If I had the ability to create a structured product with an investment bank, something like a default swap, then I would, because you can't short them because of infinite risk getting squeezed. Won't be able to buy deep out of the money puts because they'll likely be way overpriced relative to what a fair value on the expected volatility should be. But I can pretty much guarantee you most, if not all, of these 5x funds will get taken to the cleaners as soon as the market has a decent pullback. And that's what they call in finance a moral hazard, because when they blow up, volatility shares still get to keep all their management fees. It's kind of like flipping a coin with volatility shares. Lands on tails, you and them win. Lands on heads, just you lose. They have all the upside with no downside. So it's easy to see why they would do this. They'll collect a lot of fees because no doubt these will be really popular. Traded, leveraged ETFs, but no doubt they're on a path to zero. As we're getting more and more fund managers coming out with 3 times leveraged ETF. No doubt a sign of the times. Doesn't mean it's going to end tomorrow or next week. This could still go on for another year or two. But in my opinion, it just keeps gamifying the stock market, which isn't really a good thing. As I agree with long-term market veteran Walter Deemer, beginning to think all these highly leveraged ETFs are going to be behind a market meltdown sometime. They may not be the single root cause of a market meltdown, but they certainly will exacerbate it. Seen a huge whine in key assets being levered up, which unfortunately a lot of newbie investors will have to learn the hard way not to use leverage. And hopefully we don't see a big wipeout like we did in 08 and 09. Because if the SEC does approve these 5x levered ETFs, I think it's on them for allowing investors to buy them. Because no doubt some people like this guy here will put his entire portfolio on it. It's just like making grenades available to purchase. If anybody can easily buy a grenade, guess what? You're going to see a lot more grenade attack. But if no one can buy a grenade, you're not going to see so many. So was this latest dip really a buying opportunity? No doubt the buy the dip strategy has worked really well this year. Anytime the market has had a little bit of a sell-off, it's pretty much bounced back. But no doubt it won't always do that. And when we do get a decent correction in the market, no doubt we're going to see many bears pat themselves on the back and say they were right all along, even if they did miss out on the first 1000% of gains. And so I'm not trying to be bearish. I like to think of myself as a realist with a splash of optimism. And as my regular viewers know, I'll always be a permabull. I just know not to use leverage because, like Charlie Munger said, if you can't handle your portfolio going down 50%, you shouldn't be in the stock market and stick to short-term bonds instead. And just generally speaking, if you're optimistic, you'll live longer as well. But just moving on to where else I think could be a potential bubble forming, where pretty much nobody is calling it a bubble, is gold. We are seeing plenty of sentiment and technical indicators at extremes for gold. Looking at the value of call volume minus put volume, all-time highs for the gold ETF. Technically speaking, the weekly RSI, a technical oscillator, also at all-time highs for gold, which we can often see gold pull back a month to 6 months later, but also it can occur near bull market peaks as well. Just like extremes and fund flows can often be a signal of peaks, like we saw in the IAU gold ETF back in late 2020 and again in 2011. We're getting similar peaks in fund flows. In other words, a lot of people being rushing in to buy gold even after it's run up so much. And that's because human nature doesn't change. Everybody and their dog is bullish on gold. Newbie investors that haven't studied market history, they're seeing it all throughout the media, they're seeing their friends making money, they're looking at the chart going up every day, and unfortunately, people pile in at these extremes. Like I've always said, nothing wrong with owning a little gold. There's also nothing wrong with trimming a little, selling into strength. Taking the other side of the crowd is how you make money. And so no doubt we could squeeze further here to 5,000 2000 on gold, but I would be surprised if next year gave us the same performance. And in fact, I think we'll be lower in gold in a year or two. And just getting back into the charts, we actually saw their new Roundhill meme stock ETF come off a bit today. A lot of these hot stocks looking super stretched in the short term, getting reversal signals here. Names like AST Space Mobile, Rocket Lab, and the hot rare earth sector also having a bit of a breather today. Again, on exhaustion signals. Same again in AI infrastructure. Reversal signals, very technically overbought, been in a super strong trend for a few months now. Crypto stocks as well. I'm expecting a sharp dump at some point in the next week or so. Don't be surprised to see a lot of these names off 10 or 20% in one day. Coming back to their moving averages, where they may consolidate and the dip could very well be bought. But overall, looking at the Russell 2000 small cap index, the structure's pretty good. Once again, breaking out to all-time highs today and looking good relative to large cap. The Russell versus the S&P having a strong breakout this week. Looking good on the monthly chart as well. Potentially taking out this downtrend that it's been in for a few years. So I really like the look of small caps overall. It's just that the really hot ones are technically stretched in the short term here. And even looking at the Russell versus the NASDAQ Qs, actually just took out the 200-day moving average yesterday for the first time in a long time. So again, another good technical sign of small caps overall. Just be careful with that high beta stuff. And like I said, the VIX term structure is right on edge. The market is very vulnerable to a sharp pullback here, especially on escalating rhetoric between the US and China. We see any new big moves tomorrow or the next day going into the weekend, we could get another uncoiling and this big red candle could still very much be in play. That's all I got for you today. Thanks very much for tuning in to the Daily Market Review. My name's Jared and I'll be back here again this time tomorrow. Cheers.